Hi everyone, Mark Lichtenfeld, Chief Income Strategist with the Oxford Club. Welcome to State of the Market. Have you ever woken up in the morning and your stock is jumping because an analyst upgraded the stock? That feels pretty good, right? Well, how about when your stock is down because some schmuck downgraded the stock to neutral or even sell? That is maddening. I mean, I have to tell you, it astonishes me that stocks still react and people still care about what these analysts think. I mean, who gives a what these analysts say? These guys are wrong more often than Cheech and Chong taking an SAT test. Now, let's talk about first what a sell-side analyst is, and I'll show you why they're wrong so often. On Wall Street, you've got the buy side and you've got the sell side. Now, the buy side are the hedge funds, the mutual funds, the pension funds, the people who buy investments. The sell side are the big institutions you know and don't love, the Goldman Sachs, the Citigroups, the Bank of Americas. These are the people that are selling investments. Now, buy-side analysts typically don't publish their research or their opinions on stocks because there's really not much of an incentive for them to do so. The sell side, on the other hand, they publish their reports because they want the buy side to act on those recommendations and trade those stocks through the sell side's trading desks, which generate commissions. Okay, so now that you know the difference between the buy and sell side, let's talk about why the sell side is such a joke. At the end of the year, 54% of all ratings on the S&P 500 were buys, 40% were holds, and 6% were sells. So you can see there is a strong bias there. Now, it makes sense because if you're an analyst and you rate a stock a sell, your bank can pretty much kiss goodbye any chance it had of landing investment banking business with that company the next time that company needs to raise capital or execute an acquisition deal. Now, I want to tell you, I was a sell-side analyst at one point, albeit for the most contrarian research firm on the street. So we did things very differently, but I do know how the game is played. Most analysts will not risk sticking out their necks and making a bold call because if they're wrong, they're going to have to explain to their boss why everyone else on the street got it right, but they didn't. So analysts tend to engage in groupthink. Now, another reason is that the way that the analysts are scored. So when an analyst puts out a buy or sell rating, it almost always comes out before the market opens. And as a result, they are given the closing prices from the night before. So if a stock tanks on bad news, as long as they get their downgrade out before the market opens, they get yesterday's closing price. So years ago, I was talking to an analyst friend of mine who had a buy rating on a biotech stock, and the company had released clinical trial data early that morning that was very weak, and the stock was tumbling about 30% before the market opened. And I was meeting him for coffee early that morning and said to him, "I'm sorry you're getting your head handed to you on the stock." And he kind of shrugged it off and smiled and said, "No worries, I got the downgrade out before the open, so I get yesterday's closing price." Well, that might be well and good for my friend, but not so much for his clients that actually listened to him and bought the stock on his recommendation and cannot turn back the clock to get out at yesterday's closing price. Now, one of my favorite pastimes is mocking the analysts on my Twitter feed, which is at Stocks and Boxing. Stocks, letter N, boxing. And don't worry, there's very little boxing. It's almost all stocks. So here's a few of my recent favorites. B of A downgrades NextEra Energy Partners to sell from neutral on valuation. It was rated sell last February at around $40, upgraded to neutral in October at around $46, downgraded to sell today at $81. If you listen to B of A on this stock, you missed a 100% gain in a year. Roth Capital hikes Etsy price target to $235 from $165. The stock is at $212. Price targets are meaningless. And after Tesla was up tenfold in a year, Evercore raises Tesla to in line from underperform. Hashtag good call. Lastly, I think this tells you everything you need to know about the sell side. And keep in mind, this comes from a sell side firm, Bank of America. Now, B of A keeps tabs on sell side strategists. And when these strategists recommend that investors hold 60% or more of their portfolio in stocks, in other words, they're very bullish, Bank of America considers that a sell signal. So in other words, even though they are a sell side firm, they acknowledge that the sell side is usually wrong. Look, it'd be really easy to paint these analysts as a bunch of clowns, but they're not. They're actually very smart people. But there are conflicts of interest in the way they operate, and they have no incentive for bold thinking. And as a result, they are very frequently wrong. I truly don't care what an analyst thinks about my stocks, and you really shouldn't either. All right, that will do it for State of the Market. Thanks for watching. For more income and wealth building ideas, just click on the link below to check out my free e-letter, Wealthy Retirement. I'll see you next week.